Background information on the 2001 stock market crash. The 2001 stock market crash refers to a significant decline in the stock market that occurred in 2001, following the dot-com bubble. The dot-com bubble was a period of time during the late 1990s and early 2000s where the stock market saw a rapid increase in value due to the increased investment in internet and technology companies. However, the bubble eventually burst, causing many of these companies to fail and leading to a decline in the stock market. The 2001 stock market crash marked a significant decrease in stock values, which had a negative impact on the economy. Brief explanation of the events leading up to the crash. The events leading up to the 2001 stock market crash can be traced back to the dot-com bubble of the late 1990s and early 2000s. During this time, there was a significant increase in investment in internet and technology companies, causing a rapid rise in the value of the stock market. However, many of these companies were not profitable and were overvalued, leading to a bubble that was bound to burst. In early 2001, the dot-com bubble began to deflate as the reality of the lack of profitability for many of these companies became clear. The dot-com bubble burst caused a decline in the stock market, which then accelerated due to a number of other factors, including a slowing economy and the September 11th terrorist attacks. These events combined to create a perfect storm that led to the 2001 stock market crash. The dot-com bubble. Definition of the dot-com bubble. Definition of the dot-com bubble. The dot-com bubble refers to the rapid increase in the value of the stock market during the late 1990s and early 2000s, fueled by investment in internet and technology companies. Many of these companies were unprofitable and overvalued, creating a speculative bubble that eventually burst. Explanation of how the dot-com bubble led to the crash. Explanation of how the dot-com bubble led to the crash. The dot-com bubble created unrealistic expectations for the potential of internet and technology companies, causing a significant increase in investment in these companies. However, as the reality of the lack of profitability for many of these companies became clear, the bubble burst and caused a decline in the stock market. This decline then accelerated due to other factors, such as a slowing economy and the September 11th terrorist attacks, leading to the 2001 stock market crash. Key players in the dot-com bubble. Key players in the dot-com bubble. Some of the key players in the dot-com bubble included internet and technology companies such as Amazon, AOL, and Pets.com, as well as investors who were heavily invested in these companies. Additionally, investment banks and venture capital firms also played a role in the bubble by providing funding to these companies and promoting their potential for growth. The crash. Explanation of what happened during the crash. Explanation of what happened during the crash. The 2001 stock market crash was a significant decline in the stock market that occurred in the early 2000s. The crash was characterized by a rapid decrease in stock values, as investors sold their stocks in response to the bursting of the dot-com bubble and other factors such as a slowing economy and the September 11th terrorist attacks. The crash was also marked by a decrease in investor confidence and a rise in market volatility. The impact of the crash on the stock market and economy. The impact of the crash on the stock market and economy. The 2001 stock market crash had a significant impact on the stock market and the overall economy. The rapid decrease in stock values caused a decrease in investor wealth and led to a decrease in consumer spending. This, in turn, led to a slowdown in the economy and an increase in unemployment. Additionally, the crash also had a negative impact on the technology and internet industries, as many companies that had been overvalued during the dot-com bubble failed. The role of the dot-com bubble in the crash. The role of the dot-com bubble in the crash. The dot-com bubble played a major role in the 2001 stock market crash. The rapid increase in investment in internet and technology companies during the bubble led to an overvaluation of these companies and created unrealistic expectations for their potential. When the bubble burst and the reality of the lack of profitability for many of these companies became clear, the stock market saw a rapid decline in values, leading to the 2001 stock market crash. Aftermath of the crash. The recovery process for the stock market and economy. The recovery process for the stock market and economy. Following the 2001 stock market crash, the stock market and economy underwent a recovery process. The Federal Reserve took steps to stimulate the economy through monetary policy, such as lowering interest rates, and the government passed economic stimulus packages to help jumpstart the economy. Over time, the stock market and economy gradually rebounded, although it took several years for the stock market to reach pre-crash levels. Lessons learned from the crash. Lessons learned from the crash. The 2001 stock market crash served as a wake-up call for investors and regulators, highlighting the importance of due diligence and caution in investing. The crash also showed the dangers of speculative bubbles, and the importance of considering the fundamentals of a company before investing in its stock. Changes made in response to the crash. Changes made in response to the crash. In response to the 2001 stock market crash, regulators and lawmakers took steps to strengthen financial markets and prevent similar crashes from occurring in the future. For example, the Sarbanes-Oxley Act was passed to improve corporate governance and increase accountability for companies and their executives. Additionally, the Securities and Exchange Commission implemented new regulations to increase transparency in financial markets and prevent insider trading. These changes aim to restore investor confidence and make financial markets more stable and secure. Conclusion. Summary of the key points of the video. Summary of the key points of the video. The video provided an overview of the 2001 stock market crash, including the background information and events leading up to the crash, the dot-com bubble and its role in the crash, and the aftermath of the crash and the recovery process for the stock market and economy. Additionally, the video discussed the lessons learned from the crash, and the changes made in response to the crash to prevent similar crashes from occurring in the future. Final thoughts on the importance of understanding the 2001 stock market crash. Final thoughts on the importance of understanding the 2001 stock market crash. Understanding the 2001 stock market crash is important for several reasons. Firstly, it highlights the dangers of speculative bubbles, and the importance of considering the fundamentals of a company before investing in its stock. Secondly, it shows the impact that the stock market can have on the overall economy and the importance of a stable and secure financial system. Lastly, it demonstrates the importance of taking lessons from past events to improve the stability and security of financial markets in the future. By understanding the 2001 stock market crash, individuals and institutions can make informed decisions and take steps to prevent similar crashes from occurring in the future. Thank you so much guys for watching. Don't forget to like, share and subscribe. See you in next video. Bye.